Hello, everyone. We're going to be solving a problem in chapter 6, budgeting, specifically cash budget. This is the problem in your handout. So we're going to start with the month of January, and then we're going to move on to February. We have 2 months. So this is a cash budget. We have information for January, information for February. So let's start with January. And the problem is asking for cash collections and also cash disbursements. So let's start with January. But before we start with January, we want to write down the collection schedule if we're going to be solving for collections, and then the disbursement schedule when we solve for disbursements. So collection, how do we collect? Step number 1, write this down. It's going to help you. So the collection schedule says that we're going to be collecting 60% in the month of sale and 40% the following month. So if we are in January, we are going to be collecting 60% of sales in January. Okay. And then 40% of whatever we sold 30 days before. Okay, remember, put yourself in the right timing. If you are in January, you cannot collect whatever we're going to sell. You're projecting on selling the following month. February, you cannot collect because you haven't sold it yet. So you have to look back in time. In January, we are the next month of December. So whatever you sold in December, you collected 60%, and the 40% remaining, you're going to collect in January. So right now we're in January, okay? So December, 40% of sales, which is still uncollected. It should be sitting in accounts receivable. We're going to look at that next, okay? All right, so let's start with the month of January. We want to do collections in January. So what are we going to do? We're going to look at January sales right here, 207. Okay, so we have 207. 60% of that will be collected. So we are collecting 207 times 60%, 124,200. Now, we're also collecting 40% of the sales in December. We're not given December sales. However, we are given accounts receivable. Look at this 29 right here. 29 is what we haven't collected from whatever we sold in December. We're being told that we typically collect 40% following month. That means that in December, we collected 60%, whatever we sold, and the 29 we didn't, which we're going to be collecting in January. That's what we're collecting now, okay? So December, we can just take the 29,000. We're going to be collecting in January, all right? Okay, so the total collections in January are 153,200. But again, I'm going to do a T account because some of you might be going like, what's going on with that accounts receivable? I don't get it. I don't understand. Can you please explain a little more? So here we go. Let's do a little T. Okay, so it's going to be our accounts. Oops. Let's see. Let's do the entry for December. Okay, so December sales, 60% will be collected in December, and 40% will be collected in January. And then we have total sales. We don't know total sales, right? But we do know what we haven't collected yet, which is still in accounts receivable. So beginning balance of accounts receivable is 29,000. And I'm gonna show you where this 29,000 is coming from. So remember how we play with percentages? 60 plus 40 equals 100. Okay, so this is your 100 right here. And we can play with cross multiply. Okay, it's just change this right here. So Excel likes to make it. There we go. So total sales 100%. 60% collected in December, 40% collected the next month, which is January. Total sales, we don't know. We do know how much we're collecting in January. This is 29. It's still in accounts receivable. Okay. So we can easily compute what your total sales will be. 100 times 29 divided by 40. Okay. So we can do that. 100 times 29,000 divided by 40. That was total sales. December, we collected 60% of that. So we can do this times 0.6. Okay. So if we add these two together, we get the 72,500. So this information I'm not going to ask you to get. So don't panic. If you're still struggling with percentages, I'm not going to ask you to find what is total sales for December. No, 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 no. But I do want you to understand that the 29 is not collected in December, it's collected in January because it's the next month of December. That's what we're collecting it today. Okay, that we're in January. All right, so that entry, let's say that it's one single sale, just to make it easier. That will be you're getting cash and you are also selling on account receivable, which you're gonna collect the following month. Okay, receive. And then sales revenues. This is a consolidated entry. Okay, so December, you will be collecting 43,500, 29,000 will go on receivables, and your total sales revenues will be the total amount. Okay, so where is this 29,000 coming from? From this entry right here that you made in December. You're gonna debit the account receivable, which you're going to collect in January. So this is your December entry right here. So leave a little bit more room. So in December, okay, you collect the 43,500, which is 60% of the total sales. And then in January, related to this transaction, you're collecting the 29, right? 29, and you're decreasing the accounts receivable. 29. Okay. So again, this 29,000 comes from sales made in December, which you're collecting in January, 30 days later. And you're also collecting the 60% of whatever you're selling in January. So the sum of these two, 153,200. All right. Okay. Now let's do I'm gonna scroll down and bring this down with me. Okay, let's do the right here. Okay, let's do the collections for February. February, how much are we collecting? We're collecting 60% of what we are selling in February. And we're going to collect 40% and what we haven't still collected from January. Okay. So how much are we selling in February? 100,000. So this is 100,000 times 60%. In January, we know that we sold 207 times 40%. So total collections in the month of February are 142,800. So if you want to see the whole thing here, scroll up. So in January, you're collecting 153. Okay, right here, total collections. January, February, total collections. Okay, your sales in February went down a little bit, so it's expected to collect a little less. Okay. Now let's talk about disbursements. So for disbursements, it's always a good idea to, first of all, step number 1 in cash budget. We're going to do disbursements. Let's write the disbursement schedule. How do we pay? Let's look here. Look at this. Purchases are paid in full. In full, the following month. So the disbursement is 100% of purchases. Of previous month. That's how much you're going to be paying. You're going to be paying 100% of what you bought the previous month because right now you are the month that is following the month of purchase. All right. What else? Any other disbursement right here? Let's go down the list. Administrative cost. Okay, we're gonna have that. Beginning balance of accounts receivable, blah, 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 blah. Purchases are paid in full. That's it. That's it. Okay. I don't see any depreciation here. If you see depreciation, ignore it. It's not a cash expense. So do not use depreciation for cash budget. However, you do use depreciation for income statement expensing. Okay. So don't get confused. All right. Let's do the disbursement in the month of January. So for January, we're going to be paying 100% of what we purchased in December. And guess what? That is going to be sitting in our accounts payable. So let's see what we have. Do we have accounts payable? Oh, right here. Beginning accounts payable. 67,000, and it's all from inventory. How easy is that? So 100% of December purchases sitting in accounts payable, 67,000, plus the administrative costs, which we're being told are 10,000. Total disbursements for the month of January are 77,000. Very easy, right? Now, the month of February is a tiny bit more complex because we don't have an accounts payable waiting for us. So we have to figure out how much we purchased in the month of February. So for that, you have to figure out purchases. I want you to do this chart. It's going to help you. Revenue, cost of goods sold, purchases. So what do we have? We have January, we have February. That's all we're given. So revenues in January, 207. Revenues in February, 100,000. And we're being told that the gross margin is 35%. So remember, guys, sales minus cost of goods sold equal gross margin, right? So if your sales is 100% and your gross margin 35%, that means that your cost of goods sold must be 65%. So if they give you gross margin, use the opposite for cost of goods sold. So let's figure out the cost of goods sold. 65%. And we're going to do the same for February. Okay. Why are we using 35? Okay. There we go. 52, that's good. All right. So we got to figure out the purchases. Okay. Figure out the purchases. I see Excel went down. My list went down. Okay. When you use Excel, you got to put the dollar sign to make it, to use the same cell, by the way. Hope you guys are learning Excel. Okay. Purchases. In February, we need the purchases of January. So we're going to be paying for what we bought in January. Let's do our inventory account here and see how much we're going to be purchasing. Okay. This is going to be January. We have a beginning inventory that is given to us of 16,000. We have cost of goods sold that we just figured out, 134,550. How much are we ending up with? Let's compute that. So what do we have? We have a desired ending inventory of 30% of next month cost of goods sold. So next month, cost of goods sold 65,000. We want to end up with 30% of that number. Let's figure out how much we purchased. Cost of goods sold plus ending minus beginning will give us 138.50. So 100% of purchases made in January, 138.50 plus the administrative cost of 10,000. We are collecting 148.50. And that is your collections in the month, I'm sorry, your payments in the month of February. Okay, so hopefully you guys get this, right? Good luck on your exams.